Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Today, we're going to kick off part one of a three-part series on the lost decade in stocks. In today's webinar, we're going to define the lost decade in stocks and explain the cause. In our next webinar, part two, we're going to answer the question, are we set up for another lost decade in stocks? And in our third and final installment, we're going to explain why the stable earnings family of core equity portfolios are the core equity allocation of choice for the next lost decade in stocks. Let's go ahead and get started. The lost decade in stocks is defined as a period between 2000 and 2012, where price return for the S&P 500 was effectively 0% point to point for 12 years. During which time underlying S&P earnings more than doubled, causing PE multiple compression for 12 years from 25 times earnings all the way down to 13 times earnings. This all took place while the 10-year Treasury yields dropped from 6% in 2000 to 1.75% in 2012. And over this same time frame, equity risk premium rose from less than 2% in 2000 to over 8% in 2012. For purposes of our analysis, let's consider the first three items on this list as fundamental characteristics, and the last two items on this list as macroeconomic characteristics that defined the lost decade in stocks. Next, we're going to put all these characteristics together visually with analytical charts out of the Pacific Point Research Lab. The following chart is a proprietary chart that we maintain in the Pacific Point Research Lab that illustrates the 30-year price to adjusted earnings for the S&P 500. With the price line in blue and the adjusted earnings line in orange. The red horizontal line illustrates our first fundamental characteristic, which was the price return for the S&P 500, effectively 0% for a period of 12 years. In this next chart, the red trend line illustrates the second fundamental characteristic of the lost decade, and that is the underlying earnings for the S&P 500 more than doubling over that same 12-year time frame. The next chart brings together the relationship between price and earnings to illustrate the third fundamental characteristic of the lost decade, which was the PE multiple compression over the 12-year time frame. This is illustrated by the convergence of the two red lines, where price trended flat for 12 years against a backdrop of earnings that increased more than 2 times over that same time period. The next chart brings together the PE multiple for the S&P 500 with our two macro characteristics that define the lost decade in stocks. Pay particular attention to the overall trend of each series illustrated by the corresponding trend lines. The first panel illustrates the PE multiple compression from 25x to 13x over that span of 12 years. The second panel illustrates the 10-year Treasury yields dropping from 6% in 2000 all the way down to 1.75% in 2012. And the third panel illustrates the equity risk premium rising from less than 2% in 2000 to over 8% in 2012. Let's recap the lost decade. That period between 2000 and 2012, where price return for the S&P 500 was effectively 0% for 12 years. Underlying S&P earnings again more than doubled, PE multiple compression for 12 years from 25x to 13x, 10-year Treasury yields dropping from 6 to 1.75%, and equity risk premium rising from less than 2% in 2000 to over 8% in 2012. The last several slides, we've illustrated this visually. The S&P 500 price action relative to the change in the 10-year yield during the lost decade was 100% contrary to the common belief that declining rates are good for stock valuations and rising rates are bad for stock valuations. As you think about the lost decade, imagine for a moment the following scenario we are facing in this post-COVID environment. We now have a rising interest rate and a rising cost of capital environment, in contrast to a declining interest rate and a declining cost of capital environment experienced in the lost decade. We have corporate earnings growth under pressure due to rising rates and rising cost of capital, in contrast to a more monetarily supportive environment for earnings growth experienced in the lost decade. With equity risk premium back at 22-year record lows, consider the implications for equity valuations in the face of another rising equity risk premium environment capable of lasting a decade or more. So exactly what caused the lost decade? Let's take a quick look at the price and earnings chart for the S&P 500 again, along with some individual stocks before we answer that question. The following chart again illustrates what the lost decade looked like for the S&P 500. Again, you see the flat line in price against the backdrop of the rising earnings, causing that PE multiple compression over that 12-year time frame. The next several slides, we'll take a look at some of the S&P 500 members exhibiting the same exact qualities over that same time frame. Here you can see Microsoft flatline in price against that backdrop of underlying earnings growth causing that PE multiple compression over 12 years. Same thing for Intel, although the underlying earnings trend a little bit more cyclical for some of these chip names. Again, you can see that over time, that trend line drawn here showing that same exact relationship of price with underlying earnings converging, causing that multiple compression over time. It's not just technology stocks, as you can see from the likes of Walmart, same exact trend, flat line in price for literally 12 years, while we experience tremendous underlying earnings growth, causing that same multiple compression. Same thing for the lost decade for Home Depot. Same thing for Walgreens Boots Alliance. So the next slide, we're going to take a look at understanding the lost decade. And to understand the lost decade, we really need to understand how changes in the 10-year yield and equity risk premium affect the trend in the S&P 500 PE multiple over time. So as investors sold stocks and bought treasuries from 2000 to 2012, equity risk premium actually increased, offsetting the decline in treasury yields. Okay. So what exactly is equity risk premium and why should we care? Equity risk premium is nothing more than the interest rate premium above the risk-free rate. In our case, this is the 10-year treasury yield that investors require just to hold stocks. We need to care about this because the equity risk premium measures that portion of change in PE multiples that can be attributed to changes in macroeconomic headline risk. So wouldn't it make sense that as investors require an additional equity risk premium just to hold stocks, that we would see PE multiples contract? This is exactly what happens, and you can see it illustrated in the first and third panels in the following chart. The next chart illustrates that outside of isolated points in time, changes in the 10-year treasury yield appear to have little to no statistical explanatory power to explain movement in the S&P PE multiple over the prior 22 years. Note the red boxes and red trend lines in the following chart. PE multiples for the S&P 500 in excess of 20 times can be observed between 2000 and 2002, with 10-year treasury yields sitting at 22-year highs. And the same PE multiples for the S&P 500 in excess of 20 times can be observed in 2020 to 2022, with 10-year treasury yields sitting at 22-year lows. If you observe the red trend lines in both series, you'll see that over 22 years, the relationship appears to be more sporadic and not very well correlated. And you can see that 10-year treasury yield just consistently on the decline all the way into 2020, while the S&P 500 PE multiple actually hit bottom around 2012, 2013, and began its rise all the way through into 2020 COVID era. The following chart illustrates that equity risk premium appears to have some level of statistical explanatory power to explain movement in the S&P 500 PE multiple over the prior 22 years. Note that the red boxes and the red trend lines in the following chart, PE multiples for the S&P 500 in excess of 20 times can again be observed between 2000 and 2002, with equity risk premium sitting at 22-year lows. Then the same PE multiples for the S&P 500 again in excess of 20 times can be observed in 2020 to 2022, with equity risk premium sitting at 22-year lows again. So observing the red trend lines in both series, you will see that over the 22 years, the relationship has a strong inverse correlation. As equity risk premium rises, S&P 500 PE multiple falls. As equity risk premium declines, the S&P 500 PE multiple begins to expand. The next step would be to run a 22-year regression to determine the strength of the relationship between changes in the 10-year Treasury and changes in the S&P 500 PE multiple. We will focus on the resulting regression statistics R-squared and correlation coefficient. You can see those here at the top of the screen illustrated. A quick definition for everyone: R-squared is defined as the coefficient of determination. It ranges between 0 and 1, and it measures how well changes in the independent variable can explain changes in the dependent variable. To keep it simple, in this case, we'll just measure how well the changes in the 10-year yield can explain changes in the PE multiple for the S&P 500. At Pacific Point, we classify any R-squared in excess of 0.60 or 60% as statistically significant. In the following chart, the R-squared of 0.01 or 1% is telling us that changes in the 10-year Treasury yield can only explain 1% of the change in the underlying S&P 500 PE multiple over time. We can conclude that the relationship is not statistically significant and has no explanatory power over the prior 22 years, including the 12-year period of the lost decade in stocks. Additionally, a correlation coefficient is a number between -1 and 1 that tells you the strength and direction of the relationship between the two variables. You can see that correlation coefficient of 0.12, indicating that there's no relationship between the 10-year Treasury yield and the S&P 500 PE multiple over time. Next, we're going to run that same regression, only this time we're going to determine the strength of the relationship between the changes in equity risk premium and the change in the S&P 500 PE multiple. We will again focus on the resulting regression statistics, R-squared and correlation coefficient, which again, you can see at the top of your screen. In the following chart, the R-squared of 0.73 or 73% is telling us that changes in equity risk premium can explain 73% of the movement in the underlying S&P 500 PE multiple. We can conclude that the relationship is statistically significant and has material explanatory power over the prior 22 years, including the 12-year period of the lost decade in stocks. Additionally, you can see the strong correlation coefficient of -0.85, indicating that there's a strong inverse relationship between the equity risk premium and the S&P 500 PE multiple. How do you explain what happened in the lost decade? Point number one, there was a slow exodus in the appetite for risk over time. Off the back of the dot-com and 9/11 era, investors developed a risk-off appetite over time and were selling stocks and piling into treasuries and fixed income securities. Point number two, there was a large risk sentiment shift that took place as that slow exodus and appetite for risk took place over time from 2000 to 2012, when we measure this by equity risk premium. When 10-year Treasury yields collapsed for 12 years from 2000 to 2012, the premium investors required to simply maintain exposure to stocks, remember we define that as equity risk premium, rose to more than offset the decline in the 10-year Treasury yield. And I want to repeat that. That equity risk premium actually rose to more than offset the decline in the 10-year Treasury yield. This better than one-for-one offset between the change in the 10-year Treasury yield versus equity risk premium represented a material shift in risk sentiment over time. Point number three, S&P earnings growth was actually unable to outpace the PE multiple compression resulting from the rise in equity risk premium. The rise in equity risk premium ended up absorbing all the price appreciation due the S&P 500 relative to its own earnings growth from 2000 to 2012. As a result, stock prices stagnated over time as money flows moved from stocks to treasuries and fixed income securities. A 12-year period of multiple compression was the ultimate result as prices flatlined against earnings growth, which on average increased again at a rate of more than 2 times from 2000 to 2012 for the S&P 500. I'm going to leave you with this thought. Based on what we've learned about equity risk premium and the relationship between PE multiples and the influence on the lost decade, if a portfolio of stocks is going to experience price appreciation over the next lost decade, it would appear as though the primary requirement would be the underlying earnings growth of the portfolio would need to consistently outpace the valuation decline resulting from PE multiple compression in a rising equity risk premium environment. Be sure to join us next time for part 2 of the Lost Decade webinar series as we answer the question, are we set up for another lost decade in stocks? Thank you all for attending.